Question number 10. Following are the details of cash inflows and outflows in foreign currency denominations of M&P Company, an Indian export firm which has no foreign subsidiaries. So you have the currency, the inflow, the outflow, spot and forward rates are given to you. Determine the net exposure of each currency, foreign currency in terms of rupees, and are any of these exposure positions offsetting to some extent. Okay, let's do the first thing first. Now, what do you mean by exposure here? Exposure. In this case, if you look closely, they are asking for transaction exposure. Transaction exposure. Now, in brief, what do you mean by this transaction exposure is, see, you have some cash flows. Okay, an organization has these cash flows, and there is a time difference, that is, you have booked this. Okay, booked as in you've booked it in your accounts, and the other thing is when you've actually going to receive it, or when you are going to pay for it, the payment has to be made. There is a time gap between these things. Okay, there exists a time gap. Okay, for example, this there was a receipt that was booked in March, say, and the actual receipt was, say, in August. Okay, so there's a time gap. So now March is my spot, okay, when the contract was entered into, and actual receipt is the forward. Okay, so now the next part to this is this transaction exposure is only possible when the organization deals in currency other than the home currency. Okay, why I think this is quite self-explanatory, because if you deal in home currency, there is no exposure, there is no foreign exchange coming into being. Okay, if the rupee is your currency, you are dealing in rupee, then foreign exchange gain or loss, there is no question of that. Okay, because there is no other currency involved, right? But in case if you are an Indian and you are dealing in dollars, so then dollar fluctuation or a dollar discount, or when dollar is at a premium, will affect the rupee final settlement, be it receipt or payment. Okay, so deals in currency other than foreign currency, indirectly, that is deals in foreign currency, correct? And this was the second part. The first part that we saw is there exists a time lag between recording of your transaction and the actual payment or receipt. Okay, now let's see the question. They're asking the net exposure. So if you see these currencies, M&P Company Limited is an Indian export firm. For an Indian export firm, dollars, French franc, UK pound and Japanese yen are all foreign currencies. Okay, and there are inflows and outflows in this. It means the cash flows are denominated in foreign currency. So then there will be a transaction exposure. See, they've given the forward and the spot as well. So what will be the transaction exposure? What forward minus spot basically? See, let's say first let us calculate the net amount, or we could directly go to the solution. See, in the study material, it's extremely simple. Get the net year. See, because there is outflow and there is inflow, so it will be easier for us to just first net this. See, the net will be 2 lakh, which is inflow positive. Next will be 1 crore 20 lakhs, again positive inflows. Similarly, we'll do that. See, it's better we see the study material, it's quicker that way. Right here, see, net exposure, net exposure of each foreign currency in rupees. Okay, so these foreign currencies are given to you. Inflow minus outflow, you get the net inflow, and then you have the spread is nothing but forward minus spot. forward minus spot, correct? And net exposure. So this net exposure, if you see, is nothing but your NE is net cash flows multiplied by the spread. Okay. And why we are doing this is something that I've already mentioned. Okay. So now net inflow, in these three cases, if you see there is a net inflow, positive, and multiplied by spread, you get the net exposure. But for the Japanese yen, the outflow is more than the inflow, so it's negative net inflow, which is basically net outflow. And the spread, see, the spread is also negative. If you see the spread, which is for Japanese yen, forward is less than the spot. So since in this case, we'll write this here, see, Japanese yen we'll solve. First of all, it's a net outflow, or you could say, since everything we've taken inflow, so we could say negative net inflow, which is 2.5 crore minus 1.5 crore is 10 million, 6 zeros. Okay. And your forward minus spot spread, which is, this is negative, okay, because we are taking net inflows, so this is negative net inflow. Spread was forward minus spot 2.4 minus 3.2, it is 32 minus 24 is 8, so negative 8, because this is forward minus spot. Now if you see there's a negative, that is negative inflow, that is outflow, but I have to pay less. See, initially I had to pay 3.2, okay, while recording the transaction, but now the forward actual payment is only 2.4. so if you see logically also, rather than just the negative multiplied by negative is positive, this has to be positive, okay. So this comes up to 10 million into 8 is 0.8 is 8 million. This is positive exposure, okay. This is positive net exposure, correct? So this is your answer for Japanese yen. Okay, let's see. Yes, see, 8 million net exposure, positive. Okay, so now the exposure of Japanese yen position is being offset by a better forward rate. Yes, see, what do you mean by whatever is written here? See, Japanese yen, initially you had to pay more, that is 3.2. The outflow, you had to pay more, 3.2 million. We can write once again here if you need it. 3.2 million. But now you have to pay how much? 2.4 million. Not 32 million, because 10 million into 3.2 gives me 32. So we'll just quickly rewrite this. 32 million is what I had recorded, and now it was 2.4 into 10 million, 24 million is what the forward rate, okay, the forward outflow. So this, if you see, there's a reduction in outflow, reduction in outflow, so there's a gain of 8 million, correct? So you could say the Japanese yen position, the exposure of Japanese yen position, that was 32 million, is being offset by a better forward rate, okay, because now you have a gain of 8 million, correct? Bye bye.